Today we have with us David French, a CPA specializing in corporate tax preparation and planning. Thank you so much for joining us today, David.
Thanks for having me, Mark.
Awesome. So today we're going to be talking about the CPA's perspective on mergers and acquisitions. So why don't we jump right into it? How do you prepare a client for an acquisition?
So it kind of depends on the time that they come and talk to you about it, but hopefully you're a couple years out when you first hear about it. Never really works out that way, but because there's certain things you want to make yourself look as good as possible on paper. So you're gonna do different things in those 2 years up to negotiations. You want to keep those multiples as high as you can. You want to drive revenue, even if it's things that normally you wouldn't take on. You're going to take them on just to kind of beef up the numbers. So, and buyers know that too. So they'll dig into the revenue stream a little bit deeper. But I mean, you want to get those numbers up. Number one, you want to clean up your act a little bit in advance of the due diligence process. You want to look at filing requirements, states, different sales taxes, those kind of things. So, you gotta run through the list. It's almost like you work backwards from a due diligence checklist, and you kind of, you start there. Where are we at on this? What questions would we have trouble answering when it came down to the table, and what can we do differently in the time between? So.
I love that. So talk to me about what are some of the different ways that you can determine a company's value and when are they typically applied?
Depends on the industry. Services probably more based off revenue, a multiple of revenue versus, manufacturing, tech companies. You're probably looking more at the EBITDA numbers and using a multiple. But a lot of times you need to look at the balance sheet perspective too. What do you have on paper? What if you have equipment heavy, like a big manufacturer, trucks, plant, property, equipment, there's a few $1,000,000 there. You're not just going to value that the same as a company that, is leasing a bunch of equipment. So you have to put your hat on. You have to look at it from both perspectives. And a lot of times people will just use straight multiples, but it's really not that. It's not that simple. So you got to dig into it.
Mm-hmm. And do multiples typically change throughout year based on market? How does that affect the value of the company?
You mean as far as what they're using for a different company in the same industry?
Yeah.
I think it's just more of track record and name for which end of the range you're on for the multiple, and how who's trying to sell or who's trying to buy. Obviously it's all based on who's hot to make the deal happen. But it's I would say more of reputation of the business inside that industry, and you got to look at the people inside there too. The people and the clients, the employees and the clients. That's the value of any business these days. So digging into those, and that's a hard thing to really see from an outside perspective. But when you kind of see it, I would say that increases the multiple. A younger workforce versus an older workforce. I look at those kind of things. New ideas, new industries that they're getting in. I'd definitely bump up the number on that for the multiple.
Yeah. And there's typically a couple ways of structuring deals, right? There's asset sales and stock sales.
Yeah, asset sale versus stock sale. I think every owner should understand that from a tax perspective. A lot of times it could be almost the same if it's mostly goodwill. I mean, you're looking at capital gains anyway, but it's going to be a lot different on the acquirer, whether you're writing things off now, either over right away or over 15 years goodwill, or you just have an investment in subsidiary that's sitting there, no tax attribute, no deduction for a long time. So it definitely has a big difference to the buyer, and sometimes depending on the industry, little or a big effect. So basically what the asset sale is you're breaking down all the assets of the company. So typically 80% plus is goodwill in most deals, I would say, just from what I've seen. And you have no basis in your goodwill. It's all, unless you purchased it, but for the most part, it's all formed. It's all built over time, sweat equity, man hours. Your basis is zero. So whatever you're selling the goodwill for, that's capital gain right there. You're going to pay probably 20%. Most of these deals, your capital gains rates can either be 0, 15, or 20. You'd be lucky if you get zero, but you're not getting that unless it's small potatoes. There's a 3.8% tax hit also that people need to see, the net investment income tax. That comes into play with these C Corps. If you're a partnership or S Corp or even sole proprietorship, there's a way out of that 3.8% with the active participation. I've seen that missed a lot, honestly, on deals with a CPA who just kind of let it roll on the Form 8960, and you're paying 3.8% extra on the sale. So that's one thing. Definitely make sure if you have an old school CPA, maybe he's been around for a long time, not up on it. I could see that being missed because that's a new form that's been out only 3 or 4 years. So that's one. And then also one thing I wanted to mention is depreciation schedules. So like there's a thing called depreciation recapture. Let's say we sold, all right, we said 80% on goodwill, 20% to furniture fixtures, and the breakouts. Okay, basically we're selling our furniture fixtures $1 million. Our balance sheet has $2 million of fixed assets that we've purchased. We've depreciated them all, so we're down to zero again, right? $1 million a gain, right? You're going to have depreciation recapture on all of it because the depreciation that you've taken is $2 million. So you're going to pay ordinary rates up to 37%. Let's say a lot of that stuff's old. You're not even using it anymore, but it's been on the balance sheet. Nobody takes it off. Let's say we really look at it, and $1.5 million of this is old stuff. We're not even using it. It's not part of the sale. So you're left with $500,000 of assets. $500,000 depreciation. The recapture is capped at that depreciation. So you're paying ordinary income tax on $500,000 now. Capital gains $500,000. So you're shifting 17% tax on $500,000. So that's one thing. It's just simple. Everybody can do it. Doesn't come into play all the time, but with those companies with a lot of equipment and stuff, you got to look at that stuff.
Got it. We hear a lot of deals are subject to something called an earnout. Can you explain kind of what that is and some of the tax consequences that result from that?
Yeah, so the earnout, and this goes back to kind of beefing up those numbers up to the couple years beforehand. They want to make sure that revenue number is good. So, all right, we'll give you 50% cash. The rest is going to be based on this formula, right? So the tax, the way it's structured as a tax item is you need to report the sale based on the maximum earnout it could be. So it kind of leads to you picking up gain before really earlier. So that's one thing. It's really not fair the way it is, but it is what it is. So be careful with that. Make sure you understand that. And one thing I'd say for anybody who is getting ready for a sale in the middle of a sale, you need to know what your net take-home after tax is. Like there should be a tax projection that your CPA puts together for you during this process that you know exactly what's the breakout, ordinary income, capital gains, what's the tax number. Because there's so much, it's like, okay, yeah, I'm going to pay 20% on this, or I'm going to pay 25%. But it never works out as an even number. It's like you really need to dig into it a little bit because once the deal's signed and it's done, there's not much we can do. We have to be involved during the process because a lot of times these lawyers, these investment bankers, they just want to get the deal done, boom, get paid and signed. The taxes are the taxes. They're gonna do what they're gonna do, but you really got to pull in your CPA, and it's your job as the taxpayer, as the party to the contract to pull your CPA into these deals.
Yeah.
So just it's worth the time. It's like we're not charging what the lawyers are charging. We're maybe like half of that. So, and we don't need to spend that many hours on it. It's like even if you get a half a day or a day of your CPA's time during these deals, it's definitely going to be worth it. You're going to get the return on it, and even it might lead to negotiations. It might just kick back the deal in a different way that makes no difference to the other party. But once it's signed, there's not much you can do.
When should a seller bring in a CPA?
It kind of depends, but the earlier the better is the answer. Definitely 2 years before would be great. Nobody does that, but the earlier the better is really the answer.
Actually, on one of our last guests on the show, Sam Goodner, built up a 450-person IT services company, and he started structuring his company for sale 5 years in advance.
Yeah, that's good.
Even if it's not common, but it's incredible. It was incredible.
No, I like that. Even if it's a year before, great. But so sometimes you can't time it up perfectly.
Yeah.
But I think even going back to just like your relationship with your CPA is like you need to sit down with him or her once or twice a year just to kind of get the scoop, get the rundown. It's not like once a year, do the return, see you later. Like, especially when you're building something, that's going to be purchased or that you believe is going to be purchased. It's like you got to have a grand scheme on everything.
Mm-hmm.
And the CPA is like, to me, I think it's your most important person. It's your first stop on anything, really. I might be biased, but that's what I think.
What are some of the documents that CPAs will help prepare during the due diligence process?
So during the due diligence, it's more of getting on the phone call with the other side and getting peppered with questions. That some of them are internal questions about the stream of the income, the personnel. But I mean, for us, it's more on what elections are you making? Do you have this S Corp election on file? Oh, why didn't the wife sign it? There was community property. Oh, you're not doing sales tax, but you have sales in that state. Do you have nexus? This, that, the other. I mean, I think for them, it's really just to kind of just throw out there that there are some contingent liabilities out there, and kind of for me, it's more of a negotiating tool. I don't know if that's true or not, but it's just to make sure. Okay, there are some things out there that, may not be buttoned up. There may be a gray area on a few things. And you want as little of that as possible. That's why it's like talking to your CPA 2 years before that happens and working backwards from that list is kind of a good start. And the I don't know answer doesn't work well on those phone calls, those conference calls. Yeah.
Do you have any stories of maybe where a client wasn't set up correctly and wasn't prepared for the due diligence process of an M&A?
Yeah, I definitely have one where they were not set up correctly. It was an old school Texas family, owned a bunch of gas stations around the state, and they were a C Corp, and it was an asset sale. So C Corps, as we know, have two forms of taxation. You're going to pay the corporate rate, and then you got to get the money out and pay the dividend rate. And this was back when we weren't at a 21% flat corporate tax rate. So these guys paid 35% on the sale of the assets. And there's no capital gains rates in C Corps. So 35% there, then you have to get the money out, and that's 23.8%. So by the time they're walking away, they're paying over 50% taxes, and that's not even state taxes. So it's just, you need to have a vision, and you need to have an idea. And in that one, we were not pulled into the deal early enough. So in that, there's no way we're doing an asset sale, like no way. And once it's signed and you're done, you're not going back to the table. I mean, there's ways to get back there, but once it's signed, pretty much it's a done deal. So that's one thing.
If you had been brought in earlier, what could have been done differently?
I mean, there's no way I would have done an asset sale.
Got it.
Would have had to be a stock sale no matter what. Even just get creative and work around it. And that's the thing with these M&A deals and reorgs. There's so much there's so much room for creativity, honestly, depending on the different structures of the two parties and bringing in holding companies and just moving things around, making elections. There's a lot of flexibility. If you understand it from both angles, then you can put your head together and come up with something. It's not going to be right off the bat. It might take a little while to kind of go back to the drawing board and get it together, but 9 times out of 10, you're going to come up with a deal that works.
If they had structured it as a stock sale, what would have been the outcome?
I mean, we're talking about just paying capital gain rates, So basically half of the tax.
Wow.
Yeah, big numbers too. So a lot's left on the table in that one. It would have been different from the the acquirer's standpoint, but still overall the tax would have been a lot less. So it's those things that some of the time the tax stuff just doesn't get brought up, by the lawyers. It just, for some reason, it slips through. And sometimes people aren't worried about that. They just want to get the deal. They want to get the money. They hear a number, and it's what's the fastest way to get that number in my bank account.
And what's your advice to people who tell you that?
Just slow your roll, chill out. If you're sitting at the table with them, they want to make a deal happen. Don't rush it, which is easier said than done. But talk to the professionals. Let them handle it. That's always the biggest thing. And I mean, a lot of these guys that are selling companies, they've built something. They want to be involved in it. It's theirs. But you have to let some things go. You're not a better tax strategist than your CPA. You're not a better negotiator than your attorney. You may think you are, but you're not. You built a different business. You're better. You're smarter in that way. But you gotta be hands off with some of that stuff.
When you do come into a deal, how much time does it typically take to evaluate, kind of the best strategy to take, whether it's an asset sale or a stock sale or some of these other strategies?
Yeah, I mean, honestly, it's not that much work. It's 8 hours would be a full day of work would be a lot, way more than most deals. It's not going to be that much work. So you're not running up a big bill with your CPA. That's what I'm saying. It's even if it's a few grand that you're paying. And I would also say, if you don't get a good feel from your current CPA on it, you're not getting much in the way of creativity. You can always bring somebody else in. They don't need to be your new CPA, but they can kind of take a bird's eye view at it and bring some things up. That would be the time to bring up. No matter, even if you love your CPA, it's just they don't need to know. Just send everything over. All right, what's your scoop? Couple hours, take a look at the deal, and what's your input? If you're not getting much from your current guy on it, I'd say it's too big of a life event to not bring as many people in as possible on it.
Mm-hmm. So there's different types of acquisitions, like where an acquirer buys an entire company, or sometimes they'll buy just a piece of a company. Mm-hmm. Kind of, what's your experience with when an acquirer just wants to buy, maybe just a portion of a target's company?
Yeah, I mean, it's always tricky. It'd be nice if you knew about that coming up, and you kind of prepared for it. You had your financials broken out for that specific branch of your company, but it's tough. It does bring in some issues as far as breaking it out, and you want to make it as clean as possible. Contracts, liabilities, even when you're breaking out the financials, well, there's some overhead that you have in your company that's not specific to one of your lines, and how you got to allocate that. So definitely do your best to have standalone financials beforehand, or come up with a method that's going to work, and kind of bounce it off your finance team.
Talked about stock versus asset sale, but are there maybe other alternatives beyond those two that people should think about?
Yeah, so obviously the tax treatment, asset versus stock sale, is one thing to look at, but also the liabilities and contracts are a reason why people do and don't want to do stock sales. So let's say there's a medical industry client, and they have insurance contracts and patient records, and they want to have a stock sale for that reason, but they want the tax treatment of an asset sale. There's ways to do that with 338H10 elections or 336E elections. So that's something that people don't realize sometimes at the table. So I think they should definitely know that, especially in certain industries, that's an option. And it's also something that could change the purchase price. Obviously, everything's based off the taxes that you're going to pay for each party, but that's something that people need to realize is an option on the table.
Got it. Is there anything that companies can do maybe at formation as they're just starting out to help prep their company for acquisition in the future?
So even, a lot of guys will just want to do an LLC right off the bat and just kind of get it going. Well, a C Corp has one big benefit to it, if you do it right, is the 1202 exclusion, the qualified small business stock exclusion. You can exclude up to $10 million of your gain upon sale as long as you hold it for 5 years. So, if you're building something that you really have a big vision on it, and it's a 5+ year vision before you exit, and you're thinking we're going to be in the 8-figure, 9-figure sale, then C Corp off the bat, make sure you have proper documentation on it. There's a couple things you need to be aware of. The $50 million value when you get the stock, which you should be good if it's a startup and you're starting from nothing. Certain industries don't qualify, but those are mostly professional services, but not your normal tech startups. So you're usually good on that. And C Corp it's really not that bad these days with the 21% tax rate. But they're going to lose money for the most part. Most startups will lose money for at least the first 3-5 years. But it also goes a long way with investors' credibility. They want to invest in a C Corp. So everybody should understand qualified small business stock. You can exclude up to $10 million of your gain if you meet the requirements, and they're really not that difficult of requirements to meet. So take a look at that. And there's some planning opportunities around that. I had a client who is sitting on qualified small business stock, his startup, and it's in the $30 million range of what his cut it's going to be. So the max is $10 million that you can exclude. Well, if you gift part of your stock to your kids trust, that $10 million is per taxpayer. So you can give 10 to one of your kids' trust, give 10 to one of your other kids' trust. You still need to look at the gift taxes, but there's higher limits on those now. So basically you and your wife can give $22 million in your lifetime tax-free. So if you do that, then you're looking at $30 million of a capital gain that you're not paying tax on. So definitely be aware of that stuff. 1202 is it's a great code section for you C Corp guys. So look into it, talk to your lawyers and accountants about it. So don't leave that stone unturned. That's a big one.
So do you typically recommend companies structuring as LLCs or C Corps?
It depends. It really does. For the startup guys, like tech startups, the C Corps just makes sense. LLCs, it's nice to get the losses out to the investors early, but a lot of times those are passive losses anyway they can't use. And from a tax standpoint, it's a lot harder when you have 50K ones to kick out and you're giving new ownership during the year, and we have figure out the percentages based off different dates. C Corp's a lot cleaner, a lot less work on my end. So I like the C Corp for that reason. But LLCs do have a place. But go back to that 1202 exclusion, and that's something that is going to outweigh getting investors their losses early on.
One question I forgot to ask when we're talking about asset purchases is what's the tax effect of asset allocation in an asset purchase agreement?
Yeah, I think, we kind of talked about that before with goodwill versus the furniture and fixtures. But yeah, it's, depending on how you allocate it, it could be capital gains, ordinary income. That could be the difference of, 17% or so. So, most of it could be goodwill, capital gains. Even the hard assets are sometimes will be a mix of capital gains and ordinary income. But yeah, you want to, from the buyer's perspective, you want it all to be furniture and fixtures. You could write it off that year, take Section 179 or bonus depreciation, and you got this huge deduction that you can now use going forward if it's an NOL or use it currently. So, there's a big difference on how you allocate it, and those Form 8594s that you need to kind of share with each other. I'd say try to get a draft of those in, when you're signing the deals, get a draft on it. Some things are going to change depending on the final numbers, but definitely get an idea of what those look like so you can kind of get that to your accountant, and that'll help with your tax projection, knowing what you're netting at the end of the day. So it makes a difference, but it's really just capital gain versus ordinary income, to be honest with you.
Cool.
Which we want all capital gains. That's the goal.
David, this has been great. Are there any last pieces of advice that you want to leave our audience with?
I would say bring your CPA in as early as possible. It's not going to cost you an arm and a leg. It might only be a few grand, but it could swing the meter, millions of dollars. So there's no reason not to bring us in. So be smart. Bring your CPA in.
Thank you, David. This has been great.
All right, man. Thanks for having me.